Today I want to give you my opinion on how that you may be able to avoid a stock market crash tax trap. I'm Van Richards and I design financial plans that help people avoid going broke in retirement. Here's what I mean when I'm saying a stock market crash tax trap. The recent decline in the stock market from February the 20th until March the 23rd set up a tax trap for a lot of investors. The markets have rebounded a great deal since then, but this is a tax problem that will probably not happen until the very end of the year. And it's going to be a problem that's not going to happen to everybody. But if you own after-tax stock mutual funds, it's probably going to happen to you. I got into the investment business in November of 1987. That was right after Black Monday, the stock market crashed on October the 17th of 1987. And since then, I've seen what I believe is going to happen this year happen every time that there is a big decline in the stock market. You see, when stocks have big declines, portfolio managers of stock mutual funds are forced to sell stocks that they have held for a very long time just to keep up with the redemptions. And there are capital gains taxes that are due on the profits from the sale of those stocks. The sales by the mutual funds puts many after-tax shareholders into a catch-22. Investors, on one hand, may have investment losses, plus they're going to have a taxable gain at the very same time. Now, my opinion is I anticipate this happening even if the mutual fund values do come back by the end of the year because the taxable gains have already been declared. All because the fund had to sell long-held stocks to settle the redemptions when the stock market crashed. Now, if you're in this situation, I have a few ideas that I would like to share with you on how that you may be able to avoid this capital gains tax on your mutual fund. Many of you that are in this situation may also be thinking that I'm not sure that I want to sell right now. And that's okay. This is going to be information that really it's not for everybody. Now, at this point, you need to understand that really this only applies to taxable accounts. Plus, you should be very careful to consider your own potential long-term capital gains. The way that you can avoid the capital gain tax that is because of the internal redemptions is to transfer the value of that stock mutual fund to an investment that has less chance of declaring a capital gains tax before the end of the year. An investment that is very similar to an open-ended mutual fund is an exchange-traded fund, or an ETF. An exchange-traded fund is a basket of securities that's traded on an exchange just like a stock. ETF share prices, they fluctuate all day long through the market when they're bought and sold. That's different than with mutual funds because with mutual funds, they only sell one time per day at the end of the day. Now, ETFs can declare capital gains just like a mutual fund, but they rarely do. The key to avoiding the capital gains tax is to sell before the mutual fund formally declares the capital gain. Now, usually this only happens at the very end of the year, but mutual funds can declare a capital gain whenever they see that it's appropriate. Another way that you can avoid a potential gain is by owning your own individual basket of stocks. This used to be a difficult strategy because investors could only get proper diversification with a very large sum of money. Recently, I've been using an investment custodian that allows partial shares to be purchased. So you can own your own diversified stock portfolio with a much smaller amount of money. And you rarely have to deal with the internal stock redemptions that are causing unwanted capital gains. I'm Van Richards, and I design financial plans that help people avoid going broke in retirement. And I would like to thank you for listening to my opinions today. The tax planning that I'm talking about is just one of the 6 risks that investors face around retirement planning. If you'd like to learn more about the retirement planning process that I use and the other 5 risks, visit my website at richardsfinancialplanning.com. Before I end, I need to tell you that the information that I'm sharing with you, it's not a recommendation to buy or sell any specific investment. Investing does involve the risk of the loss of your investment, and the past performance of an investment is not a guarantee of its future results. Have a great day.